Good morning. This is Japanese Economic Review Channel. Yesterday, March 31st, marked a volatile end to the fiscal year as the Nikkei 225 plummeted 822 points to close at 51,063. The Topix also retreated by 44 points to 3,497. Despite the heavy downward pressure, the prime market remained highly active with a staggering trading value of 8.36 trillion yen. This reflected intense position adjustments as investors reacted to compounding global risks. The primary catalyst for yesterday's sell-off was a geopolitical domino effect, triggered by escalating tensions in the Middle East. Disruptions in the Red Sea shipping lanes led to a sharp spike in WTI crude prices. This surge reignited global inflation and interest rate anxieties, leading to an aggressive rotation out of high-multiple, rate-sensitive sectors like AI and tech. Yesterday's sentiment was heavily influenced by Monday's performance in the U.S. While the NY Dow managed a 49-point gain through autonomous rebound buying, the Nasdaq fell by over 153 points. Heavy selling in semiconductor leaders like Micron and ARM Holdings, driven by macro uncertainty, directly set the stage for the weakness seen in Japan's tech-heavy indices. The intraday chart for March 31st showed extreme volatility, starting with a plunge exceeding 1,300 points. A brief recovery occurred when U.S. President Trump suggested a halt to attacks on Iran, causing oil futures to retreat and the Nikkei to temporarily turn positive. However, uncertainty ultimately prevailed, and the market faded into the close as month-end fund exits accelerated. Looking back at the entire month of March, it was a grueling period for the Tokyo market. The Nikkei 225 suffered a 13% drop from its February peak, while the Topix fell by 11%. This double-digit monthly decline highlights a significant flight from recent historical highs, cemented by structural selling and heightened geopolitical instability. A clear trans-Pacific sector rotation was evident yesterday. While AI-adjacent sectors like non-ferrous metals and machinery faced severe contagion, domestic defensive sectors showed remarkable resilience. Capital actively flowed into services and insurance, specifically names like Infomart and T&D Holdings, which mirrored the value-oriented buying seen in the U.S. Dow. In the startup space, the Growth 250 index continued its downward trend. We witnessed a gravity check, as speculative capital rapidly fled long-horizon space ventures such as iSpace and Astroscale. Conversely, investors favored tangible domestic business models, leading to steady gains for Genda and the recently listed Sewa Holdings. Despite the market's turbulence, corporate Japan continues to expand its global and domestic footprint. Hitachi secured a major train contract in Italy, and Nissan unveiled a new luxury SUV in the US. Meanwhile, Dina opened an immersive facility in Yokohama, and Okamura advanced its ESG goals with GX Steel. These catalysts suggest that underlying business innovation remains strong despite the current macro headwinds. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.